Good morning, guys, and welcome for a new edition, a new episode of the Croissant Files live on a very interesting week. This week, you know what happened, but we go through this. So, like I said, in the presentation video that I posted on LinkedIn yesterday, I said that I would be very brief on the geopolitical section to switch rapidly to the economy and tariffs and the markets after that. So what I'd like you to do, if you don't mind, if you have questions, don't hesitate to ask questions in the comments. I will check. I would love to have some interaction with you, some interactivity, so that we can have something interesting for everyone. And there's often questions that I get that I actually didn't think about, so I would be happy to share my views because if there's something that is true, I always have something to say about anything. But that's another issue. So I hope you are all there. Let me check if there's a couple of you people already. Yes. So let's start and see what happens. Where do we start? So we start here. Maybe I don't need the no investment advice yet. So let's go. So why this nuclear? How do you call this? Whatever. It already starts. But this nuclear explosion because Trump went ballistic on the tariffs, and again we'll talk about this later. So very rapidly. The status of democracy in Europe. You may have seen that one of the high contender for the next presidential election in France has been barred to run from election based on some just inaction. She's been condemned for having kind of stolen some funds from the European Parliament, if I remember well. But she probably deserved it. But at the same time, what the main issue is the selectivity of the justice. In the Macron's government, there's probably 75% of the composition of his cabinet that has issues with justice, and not a single one has been condemned to anything. So this is exactly what's happening when they want to bar someone from running from election, and this is a situation similar to the ones that we've talked about in Romania, where the guy that was leading in the poll, just like Marine Le Pen, was barred from running for elections. You have similar issues in Germany. Germany is thinking about doing the same thing for the AfD party. We had some assassination attempts against Fico in Slovakia, who is not really in line with the EU orientation, which is the same for Orban in Hungary, who is not in line with EU orientation, and is facing a lot of problem with the European Union. So basically, like I often say, the European Union is turning into a totalitarian system, not to mention the control of free speech. Somehow, we can say that the U.S. Constitution is stronger than at least the French Constitution, because even Biden didn't manage to have Trump barred from running from election, but that's another story. So we can switch directly to the Middle East. In the Eastern Europe, there was no significant evolution in the Ukraine against Russia conflict, no on peace or on the front line, so we'll skip that. I just wanted to emphasize something that I've mentioned already last week, which is a gathering, a reinforcement of the US position in the Middle East, very probably considering, let's say, a conflict against Iran, probably. So we had bombers from Hawaii going to the Middle East, to the Diego Garcia base. We had, I mentioned this last week, the US carrier Carl Vinson, I believe that's the name, that is going from South China Sea to the Middle East as well. Diego Garcia, you know, that's the base that is, you know, it's a small island in the Pacific Ocean that is a UK island actually, but that is landed to the US for a military base. And this is actually from where the Diego Garcia base that they sent bombers to bomb Yemen recently. So this is where we are now. There are large forces concentrated in the Middle East. It's probably not for nothing. And Russia has already warned against any potential attack against Iran, specifically about its nuclear infrastructure. And Russia mentioned that if the nuclear infrastructure of Iran would be attacked, this would have big consequences for the whole region, not only for Iran. So when they say the whole region, obviously we are talking about the conflict between Israel and Iran, which is why the US is here, besides energy, obviously. But, you know, when Russia says this would have consequences for the whole region, we can imagine that this would have consequences for Israel as well. In the meantime, we had China is preparing as well. They have been running, military ships around the Taiwan island. And my position on this is that I really believe that if there would be a conflict against Iran, which is, you know, a part of the strong alliance between Russia, Iran, and China, probably that would be the trigger for China to invade Taiwan, while the US would be busy with Iran to protect Israel. That's just my take, but I believe that would totally make sense, especially since the US is weakening its South China Sea position to send it to the Middle East. Iran also mentioned that they would strike if the US would be trying anything against Iran. They would try to hit the Diego Garcia military base in the Pacific Ocean, which they can hit with some of their ballistic missiles. So that's it about the Middle East. One last thing about, I would say, Asia, but it's actually Panama. You know that BlackRock was trying to buy some ports in Panama to gain some stakes and to reestablish control on the Panama Canal. China is a big investor on the Panama Canal and has actually taken control of it through some of its investment companies, specifically one in Hong Kong, the one that BlackRock wanted to buy one of the strategic port from. And actually China has blocked the sale, and they have declared this national security interest, which is ironic because that's, anytime the US wants to do something that is not really very, let's say, nice, they say, okay, it's a national security interest. And it's interesting that China is now using the same rhetoric, which means that they actually consider themselves playing at kind of, start wanting to see themselves playing at the same level as the US in a bipolar or multipolar world. Maybe that's it. I probably 10 minutes on geopolitics. I believe that's the fastest I've ever been. Let's check if there's any comment yet. No, there's no, so that's fine. Don't forget to share comments on LinkedIn. These are the ones that I see. I know that I have a few viewers on YouTube. If you post your questions on YouTube, I won't see them. So please just try to send your questions through LinkedIn. Thank you. So let's move to the economy, and of course the tariffs. Tariff specific, typical Trump negotiation tactics. The art of the deal. You ask for something that is outrageous, and to stun kind of your opponent in negotiation, and try to bring it to the table of negotiation. So so the other day on April the 2nd, Trump came up with a list of tariffs on an endless list of countries. I believe that the minimum tariff was 10%, and after that it was based on the relationship. Someone put that on LinkedIn. I've seen that they figured out the relationship that the tariffs are kind of a minimum of 10, and after that it's a linear regression between the export and the imports to kind of rebalance the trade between one specific country and the US. So this is where you have China that has been hit with the largest tariff at 34%. Then you had other countries like Vietnam, Vietnam was actually 46%. You had Taiwan, 32%. So a lot of South Asian countries where a lot of goods are coming from into the US, specifically mainly electronics, actually, when you consider Vietnam, Taiwan. So Japan also been hit by 24% tariffs. So I mean, it has quite an impact on the markets. We'll talk about that right after that. But the reason there are penguins at the bottom right, and that's the funny part I wanted to mention, is that Trump even imposed tariff on the McDonald's island. You can't make that up. It's actually a very little island in the Indian Ocean. It's an Australian territory. There's nobody living there except maybe that's the illustration, penguins or seabirds. But I just thought it was funny because they say, okay, we'll tax and we'll impose tariffs on everyone, even these little penguins. I think that's crazy, but it's also funny as well. So let's put. I mean, but what I wanted to say is that imposing tariffs on an island like this, it can have two bad views for him. He says, so either he's not serious, he's doing this to troll, or he has no idea what he's doing. And then you choose what you think. But basically, Trump is kind of giving the stick to people to get him beat, but we know that he's a kind of a judo fighter who managed to return the situation by tweet, I would say. So a quick reminder about the situation. We were already in a situation where the big investment banks were slashing their forecast amid tariff tensions. We were already in a market situation that was highly concentrated, even above the tech bubble in the 2000s. Also a situation where the stocks and the US dollar were declining at the same time. As a reminder, this is very rarely happening because the US is always considered as a safe place to do business, which drives investments, and then the US dollar, but not this time. Like we've seen again from the beginning of the year, we have seen money leaving the US. So that's not good, and the last time again that it happened was in 2008, so not a good sign. And then we had last week, so the deficit, the global trade deficit for the US that skyrocketed. Why? Because companies were anticipating the tariffs that were coming from the US, what Trump said was Liberation Day. So to avoid the tariff, basically they imported a lot of stuff, a lot of goods to make their to run their companies, basically. So this is where we were at these times. You can see, maybe I can show this slightly bigger. And even I can probably do this like this so that you can see better. Yes, slightly better, I would say. So the consequence of this, so the market is there was already a lot of uncertainty on the market about the tariffs, and gold was skyrocketing about that. When we had a poll recently about what investors consider that was the best play against a full-blown trade war, and 58% of them responded that gold was the safe investment vehicle for a trade war, which explain very easily why everyone pumped into gold. Then next, the US dollar, which is consistent with what I said right before, kind of safe asset. And then only third, the treasuries that very few actually want to buy at this time. The response in the treasuries this week to the downside of the equity markets were pretty weak, actually, in my opinion. And if you look at this poll, there was only 9% considering that the treasuries were or are a good, let's say, a good hedge for a trade war. And then you have commodities, obviously. I mean, if there's a trade war, this is negative for the global economy. So commodities, if you think about oil or something like this, it wouldn't be good. You have 3 months T-bills, so cash. And the rest is irrelevant. And so just to last point of context is the deficit, the trade deficit of the US, that is considered to be flattening slightly up. But even worse is the debt that will probably skyrocket at some point. What it is predicted to skyrocket in the future, and that's basically what Trump is trying to address with the tariffs. So what can you say more? Yeah, so that's an interesting chart, because this is a list of the exports and the imports of the US versus the top 30 trade partners in the US. And you can see here why the US has the leverage, the advantage in the tariff negotiation, because the US is basically the buyer of everything in the world with every country. You say that the balance is negative for the US. The US is buying more from any country than it sells to this country. So they have the leverage, at the same level of, let's say, tariffs. The impact on a foreign country is much bigger than the impact is on the US. Actually, I think that they've made, I noted this somewhere about the calculation of the impact. For instance, yes, a 10% tariff, this was an example I found, but the 10% tariff of the US on China impact 1.7% of China's GDP, but the same tariff only impacts 10 bips, 0.1% of the US GDP. So the US has the leverage, and this is exactly what Trump is trying to use at this time against the other economies. So that goes for this one. You see in number 2 and Mexico, that's probably the worst, or two neighbors, US two neighbors. They are heavily dependent on the business with the US, so they are more or less likely to cave. Vietnam, for instance, is heavily dependent on the US as well. And I believe that yesterday Vietnam has already called the White House to start negotiating the tariffs. That is what Trump expects from most countries. Specifically, if you take Canada, Mexico, Vietnam, all the countries that are heavily dependent on the trade with the US. What else can we say about this? So what we can say is that the US is structurally in a dominant position over the world by being the buyer of everything everywhere around the world. This is a consuming economy, and most of the world is actually dependent on the leading economy in the world, which is also why we've seen and we've talked about this many times about where the money is getting invested in the US very often because that's the leading economy of the world. So that's what we can say about tariff. One of the risks is obviously that it can spur the development of the BRICS alliance. This is what will work with most countries, but this is something that may not work with the top country in the list, which is China. Why? For quite a couple of reasons. And by the way, China has imposed retaliatory tariffs against the US by the same amount, which is 34%. And basically, at this time, they are calling kind of the bluff of Trump and the US because the China is in a much different position despite exporting massively to the US. You've seen that the numbers. The US is importing 439 billion import, exporting only 144 billion, which is a 295 billion deficit. So that's huge. However, the US is heavily reliant on China for many reasons. So manufacturing. So at this time, the tariffs are supposed to help rebuild the manufacturing infrastructure in the US. But at this time, it takes time and years to rebuild. And at this time, the US is still relying on China a lot, not exclusively, but a lot, for its manufacturing necessities. So the US cannot do much against China, and China knows this. China also knows that they are one of the primary supplier for rare earth metals and minerals. I mentioned a couple of weeks ago that the US has found some rare earth materials in the US, but again, same thing. In the meantime, what do? You need to mine. It can take, like I mentioned that last week or the week before, it can take again between 5 and 20 years before exploiting a rare earth mine, specifically in the US with all the constraints, and that's what Trump is trying to lift at this time. But it will take time anyway, and in the meantime, the US will have to rely on its current suppliers, which is mostly China at this time, as you can see in the chart on the top right. What is interesting to note as well is that the China, as very like Russia, and for the same reason actually, China has already started to diversify, its relationship in economic relationship in the world. You see that that's the bottom right chart. China has significantly increased its export to the South Asia countries in a way to diversify its export. So China is now in a move to try to be less reliant on what it exports to the US, and this is why they are ready to call Trump's bluff and basically fight these tariffs. We'll see how this ends, but this will be interesting to monitor in the next weeks. And so basically after that, look, so I already mentioned that China has already imposed 34% retaliatory tariff, same that Trump imposed on China recently. And at the same time, specifically rare earth materials is so important to the US coming from China. China has also imposed some export control on 7 types of rare earth materials, and this is where it will hurt the most for China. So we know basically what game Trump is playing. It's actually pretty simple, but it's quite a significant gamble. You know that the U.S. has a massive debt. Like I mentioned, the former administration did what they could to probably impede the next administration at the time. I don't know if they had any idea that they would never win this election. I would say probably considering the candidate that they choose, but anyway, that's not the point. The point is that Yellen, specifically, when Yellen had the opportunity at the time to roll the US debt on long term at low rates, she didn't do that. She rolled the US debt at low rate, but on a very short term that is maturing in 2025. So after the Biden, the Democratic administration, which left Trump with a ticking time bomb at this time. So Trump has to deal with it, and to be able to deal with it, he wants to roll this debt that has to be rolled again, more than 9 trillion in 2025 at lower rates. Also, what is his best option is probably to force people into treasuries to lower interest rates, and somehow force the Fed as well to reduce rates. And this actually, the rhetoric around this, the Fed dropping rates has already started by that's the tweet policy management of Trump. Trump sent a tweet also on Truth Social about that recently. But this is where we are going now. So the best option is to have this result, is to trigger a market crash that will force people into treasuries. We've seen that there was gold. Gold, has been kind of always manipulated in some way. So keep gold under control. You probably won't be able to stop its rise, but keep gold under control and force investors into treasuries out of the US equity markets. And this seems to be happening. This seems to be working at this time. The 10-year note yield is down already 90 bips since its highs. We have oil price going down quite significantly as well, which is a important factor specifically for inflation. So it's kind of start to be working at this time, I guess, as Trump expects. However, it's really a big gamble, and this is something that you don't want to miss. Because again, the objective, lower rates. We have Doge in terms of cut spending. That will help probably as well on the debt side. The other plan of Trump is to propel domestic growth, and this would have this tariff global trade war would if it's a winner, would reinstate the US as the major dominant economy for the next probably decade. So there are very big stakes on this, taking everything back under control, meaning fixing the debt, fixing US manufacturing. The downside, if it fails, that would be kind of really dramatic, because that would be skyrocketing inflation. That would be retaliation from other countries. That would be now a really multipolar world, because that would strengthen the BRICS. And this probably would also mean lost midterms elections. We always have to remember that the main objective for a politician in Western countries, considering the election cycles, is the next election. And the next election in the US, it's every 2 years. So that's the reason why Trump is hitting really hard at the very beginning of his mandate, to be hopefully in a better position when the mid-mandate election come and continue his action. So this is where we stand at this time on tariffs. I believe I made quite a big recap on that. Let me check if I have questions on LinkedIn. No, I don't have questions on LinkedIn, but that's fine. If you have any questions, please send your questions. And if you think that I'm saying something stupid, please let me know as well. I'm sorry. So yeah. So maybe we can move on, unless I have something less, another thing to say. I didn't talk much about the numbers, the economic numbers that appeared this week, because this was obviously overshadowed by the tariffs. This week, the uncertainty index is skyrocketing. This is normal considering what we see. Trade policy uncertainty is going higher. The Atlanta GDP now estimate is down. You see that the gold adjusted GDP now estimate is higher, but it's collapsing as well, and much lower than the range that is currently expected by what is called the blue chip consensus. So this is where we are now. So it doesn't look good. It looks a little bit scary, because this Trump's gamble has to be working, or the situation would be potentially quite difficult. So we'll move on to the markets now. The markets which reacted pretty strongly to the tariffs. Yeah, so my dashboard, I'm just reintroducing here, because I cut this to put this on YouTube, just the specific dashboard for the ones that want to only look at the market section. So here we go again, market dashboard. Market reacted really negatively with the tariffs this week. Very strong reaction. Even before the announcement, the markets were down, and they were expecting, based on the uncertainty, and when the news came out about the tariffs on when was it? It was Wednesday night. It was way worse than expected, which explains why the market reaction was. So you see, let me show you this without a little bit more clearly. Okay, so we see that very negative week this week. The SPY, the S&P being down 9%, the Nasdaq being down 9%. There is basically nothing green except the short ETFs, obviously, and green is the VIX, the volatility index. That's basically not a surprise at this point. So it mostly came on Thursday and Friday. Yesterday was a significant down day, -6%, around -6%, between -5.8% for the S&P, slightly more for the Nasdaq. The VIX jumping 25% again yesterday. So a very, very negative reaction from the market yesterday. So we can check the dashboard. So we see that year to date we are now down for about between 13 and 14%. We are about flat on a 1 year rolling basis. If you check, I mean, the last, we are about at the levels we were in probably May last year, I believe, just on top of my mind. We are now in, people like to mention that we are in bear market for the Nasdaq, but not yet. We are only in a correction above 10%, but less than -20% for the S&P. The important part is that the short-term volatility versus the longer-term volatility, 1 month versus 1 year, short-term volatility is twice as high as the long-term volatility, which indicates again some tensions in the market. This ratio increased significantly this week, as you can see on the S&P, and the volume as well is increasing. So a lot of activity in the market. For once, the treasuries did kind of their job, up 3.3% on the week, but not as much as you would expect in that kind of situation. So that's why earlier I mentioned that the reaction on the treasuries were positive but kind of weak, and this is not a good sign. So people are reluctant to jump into treasuries, specifically considering the depth of the US, to go behind the fences on the market, if you can say that. I think that for a reaction of treasuries to be more pronounced, we would have to see that the tariffs gamble is working, meaning that the debt will be under control. Let's say expectations that the debt will come under control with this administration. So this is where we are now. You see that the US dollar, UUP, the US dollar index is negative on this week. Again, not a good sign. Even gold was negative. And the first part of the week was pretty good until yesterday. Pretty good. I mean, it was flat plus, but yesterday was a significant down day for gold. For the reason why I don't know exactly, but yesterday really felt like a liquidation in the market, in my opinion. So we have Bitcoin that is basically flat on the week, which is interesting because what it says is that sometimes it can people consider kind of a hedge. Store of value. That's what I've been using it for, but very long term. It also has some feature of a risk on asset as well. But the point is that Bitcoin has a really limited correlation with everything else, basically. And when you have a limited correlation, it doesn't mean that it will move on the opposite way as the S&P, for instance, like the risk on asset by excellence. It just means that sometimes it will move as a risk on asset, sometimes it will move as a risk off asset, and sometimes it will make something totally different or seems to be totally indifferent on what's happening beside that. So this is exactly what happens this week. Bitcoin is flat when the market, the equity market, is down about 10%. So let's move on to the next one. what did I choose to check? Yes, the equity sector. You see that all the equity sectors were down. The biggest loser was the energy sector, which is natural because all these tariffs are expected to really impact the global trade, which means that less demand for energy, and then in return, weaker profits for the energy sector. So that totally makes sense. The other ones were the tech sector, obviously, where the equity indices are massively concentrated. We've seen that the S&P is going down minus 9 something percent over the week. So the tech sector is going minus 11%. It doesn't make sense. I mean, the let's say the defense sectors are doing the job, like healthcare, like utilities. Even utilities was still down 4%, but healthcare was only down 1%, something like this. But it's still a sell-off. The volatility ratio, short-term volatility versus long-term volatility, are really high at this point, and they are increasing, specifically based on the last 2 days. The volumes are also increasing, except for utilities and healthcare, which are the defense, some of the defense sectors. So everything is consistent with what's happening today in the market. I wanted to show this. I didn't put the commodities in the slide, but I really wanted to show this. Remember when Trump was elected, this is when we had break out of this big triangle, which on the expectations that trade will be boosted internationally and domestically by the US. And today, this week, with the tariffs imposed by Trump, we have the exact opposite. Again, an expectation of reduction in the global trade, and then consequently a reduction in energy usage, and specifically oil. And you have seen oil collapsing maybe more than 10% over the last 2 days. I don't know if I have it slightly before. So you see that over the week, starting beginning of the week in gold, it was not looking so bad. However, we are heavily concentrated in, the markets are heavily concentrated in gold at this time. So in the time of liquidation, like it happened yesterday, this is the kind of thing that can also happen. And it's always the same thing. When everyone is rushing to the door, there's not room for everyone, and this is where we have significant move. Although it was an interesting move, but it's not crazy. I mean, it doesn't, at this time, I don't believe it breaks the trend, the uptrend anyway. Specifically, if the Trump rhetoric around tariff is continuing, we don't know exactly where it wants to go at this time, but there will be negotiations. When we talk about negotiations, this also means back and forth in terms of imposing tariffs, removing tariffs. So they will bring a lot of uncertainty on the market, and probably give some. No, I won't say it because I cannot give what can be considered as an investment advice. But the only thing that at this point we cannot say that the trend is broken. So let's move on. What do I have next? Yes, I wanted to show a little bit about the currencies, forex. You see, the US dollar is down. The US dollar is slight, not leaving the country, but you see that most major currencies are up against the dollar, like the euro, the yen, the Swiss franc, which is probably the safe asset currency. However, you have Australia, the Australian dollar, which is a commodity currency, what we call a commodity currency, that will be significantly impacted by the global trade reduction, and you can see that on the weakness on the dollar. Versus the dollar, sorry. So Bitcoin, I already mentioned. So you have Bitcoin and you have the rest. Today, I would say that there is Bitcoin and there are not shit coins, but kind of, because if you consider Ethereum, I don't know if you've seen I don't have it here, but if you've seen the global trend of Ethereum versus Bitcoin, it's going down and it doesn't seem to stop, and it was not stopping this week. Solana was the major hit this week in the crypto space. Maybe nothing much more to add here. So I mean, this is the chart that I show about every week. Some indices compared to the S&P 500. So the SPY, the S&P, is what you see in gray, in the background, when the lines are the spread between the S&P and some specific indices, like the Qs, like I mentioned here, the DIA, Dow Jones Industrial Average, and small caps. So what does it show you? It shows you that there is money is going out of the tech sector. It's going into the Dow Jones Industrial Average, which is kind of a safer positioning in terms of equity, kind of a flight to quality at this time. And so if you have large caps going up in a flight to quality, you have also the opposite, which is so you have flight to, but you also flight from lower quality in terms of smaller caps. This is what this chart is telling you. So again, this is TLT, so the treasuries versus the stocks. We've seen that in the drop, the treasuries have recovered about 20%, I would say, from its underperformance versus the S&P. But again, this is a pretty weak reaction. This would need to be much stronger to think that at this time treasuries are coming back as a safe asset for equity. And again, I believe, my opinion is that it's still very linked to the fact that the US debt is so huge. We need to see a resolve into the US debt situation to see the treasuries coming back as a real safer asset to diversify equities at this point, which is again the reason why the 60-40 and some risk parity portfolios have been dying since 2022. And the stagflation, which put focus on the US debt, etc., etc. We've seen that quite a few times already this year and even last year. What is this? So this is same similar chart. Some assets versus gold. So you see that everything is losing, almost everything is losing versus gold. Specifically, the S&P, the Euro stocks, the ones that are often considered safer asset like the US dollar and the US treasuries are not making anything significant against gold, but this basically shows that people are leaving equity markets for mainly gold at this time. So this is the chart that we had, and I wanted to show you this chart because this one reminded me of what happened in 2008. So obviously we had something similar on in August last year, when we had, really significant drop on in a couple of days, where we thought that we might have some carry trade unwinding, but the Bank of Japan caved very rapidly, say, okay, we won't hike interest rates anymore. You safe, and the market went back, ballooned again like crazy. I think this time is different because there is a drift between the Trump administration and the Federal Reserve. The Federal Reserve is unlikely to be as accommodative as the Bank of Japan is for the equity markets. We will see what happens. I think there's a political, the Fed is supposed to be independent, but we all know that it's not. So we will see that if the Fed will be reluctant to cut rates, but they probably will have to if the market is going down significantly anyway. So, and the reason why I said that it looked like, let's say, a liquidation day yesterday, simply because almost all the assets were down yesterday, including gold. The only one was significantly positive was the treasuries, but again weaker than expected in this specific context. But we had gold going down, oil going down, basically everything was going down except treasuries, if I'm not mistaken. And the other reason why we can, it looks like a liquidation is because of the volumes. The volumes were pretty significant yesterday on the sell side. We had, an attempt for a late day rally that, failed massively, and the market went even deeper yesterday. So it was not looking good. The issue is that this is what I've mentioned the past couple of weeks, is that let me put that back. So one of the issue is that we've seen that on the previous dip, the high net worth individuals came back on the market. This is what we talked about last week. We had retail coming back in the market last week. So they were adding position and buying the dip aggressively, probably conditioned by what the Fed has been doing or since basically 2008, when they implement the Fed put, to inflate every asset and the equity market specifically and prevent them for falling. But the issue is that it might be different this time. I'm really curious about what the Fed will say and will do if it continues, because again, the market was bought on the first dip. You had JP Morgan reporting that on this Thursday, 2 weeks ago, no, not 2 weeks, 2 days ago, when the market first dipped again, you had 4.7 billion of retail investing, which was the largest level over the past decade. So the retail bought massively this dip before being hit on the next day. So we were in a position where some investor, at least retail and high net worth individuals, were in a position they were waiting for the dip to come to invest, and they did, hoping that the market would go back. Typically a martingale strategy. And when the market went down again 2 days ago, they invested again. The problem is that when you had the market going down like this, it might, spiral and, snowball effects, when you might have, specifically if these are leveraged positions, margin call that will force further selling. And the other issue is that the one that bought the dip and the market is going down aggressively, now they may want to wait for a bounce back to sell their position at the bigger price. So what this means, that doesn't mean, it doesn't say that if it will be going up or down. What it means is probably there's still a lot of volatility coming in the markets over the next week, next few weeks. So that will be very, very interesting to watch. Maybe just like 2008 was a very interesting period to experience and survive. You can survive that kind of situation in the market. Probably you can survive most markets. So that will be really interesting. So we can. I have other things to show you. Let me check if I have a couple of questions. If you don't have questions, I will never ask you again, guys. Okay. Does it make sense? Let me check. I have. What is this? I'm checking just one thing because I'm not sure that the questions are actually wrong. Whatever. We'll see. And I might be done in an hour, which is interesting. If you know what I mean. So what is this chart? Let's put myself back at the bottom so that you can see this properly. So this is the S&P since 2010 after the 2008 crisis. So we are in a drawdown slightly above 15%. I believe I said that at the beginning of the dashboard. It's about minus 17%. So where does that put us? That put us at nearly the bottom of the, controlled drawdown that I would say that we had in 2022. This would be making us midway from the drawdown we had in 2020, which was an aggressive selling in the context of the pandemic. But other than that, it puts us at levels that we witnessed in 2018, the end of 2018, very low liquidity around holiday period. At the end of the year, we had, sharp leg down and a big bounce right before the end of the year to keep some numbers right for some fun. But it's also some levels that we had during an Asian crisis, or was it the European crisis in 2011? I don't remember, but whatever. So it's not we are not into crazy stuff already. We are in a crisis situation, which is generated by the tariffs, but we are not in uncharted territory. We are not in crazy stuff. Again, remember what happened in 2007, 2008. We had bankruptcies starting. We had, I remember, BNP Paribas closing funds at some points, and that we had banks into bankruptcy until Lehman at the September October 2008 before it unraveled until March, when the Fed said, okay, game over, we'll give free money, and that's how they stopped the bleeding at this point. So we are obviously far not there yet. I don't think you can say that, actually. We are definitely not there yet, but this is where we are. We are controlled fall. This is probably a term that you probably can use in when you're diving from a plane, skydiving, something like this. It's a controlled fall at this point. The only issue is that Trump has to make sure that it doesn't turn into something that is uncontrollable. Like I mentioned, at the end of the economy, this is quite a big gamble. Again, similar chart that we can see in the drawdown. Drawdowns are obviously very similar to the VIX. So this is where the VIX is at this time, similar to the VIX levels that we had the recent August, that we had in 2020, the volatility spike in 2018. And all the different crises that we had in 2015, in 2011, 2010, and obviously the most recent big crisis was the 2008 crisis, what they call the Great Financial Crisis. I mean, I'm always, surprised by all the fancy words that they managed to come up with. But anyway, again, comparison since 2020 between the S&P and the VIX. The VIX, just to show you, I mean, the spikes, the drawdown, I mean, probably nothing much more to see here. That now gets slightly more interesting, because that's the activity indicator based on historical volatility and the volume. So we see that the volatility has spiked quite significantly or this week, and specifically over the last 2 days after the tariffs. The volume didn't as much, but the volatility spiked. And the bigger issue is that specifically for volatility adjuster strategy, volatility spiking again like this means that it will probably trigger some reduction position for long long equity risk adjusted strategies. So that is something to monitor, and basically that's what I'm showing this. It's really a theoretical exposure that a fund that would implement risk parity on equities would have. So we see that on the first drawdown, we had some volatility increase that led to some selling pressure, meaning reduction in exposure for this type of fund. Now, what happens is that with the volatility spike over the last 2 days, and specifically yesterday, another significant increase in volatility may trigger, or probably will trigger, for the remaining long equity strategy, reduction in exposure, so more selling pressure. So I think that on Monday might be quite interesting. Monday might be quite interesting for one specific reason. This one specifically, we might have more deleveraging in equities than we experienced before. So further pressing seller selling pressure. Sorry. So more selling pressure coming from the increase on volatility, if you want to control for those strategies and for those investors that want to control their risk. We might have some selling pressure coming from margin calls after Friday. And all the retail buyers that came in the market, especially buying the dip, we will see that if they are panicking on Monday, or if the market is take his mind back and try to say, okay, this thing is not over, we need to wait and see what will happen. But Monday will be very interesting to monitor, to see if that escalates into something less controllable, if retail panics, if we have margin calls, or if we still have some risk-adjusted investors that need to adjust their position to the risk, meaning reducing their equity exposure. So that will be, I believe that will be quite interesting. Yes, I wanted to finish with this, which is a chart that I've seen this week, and that's the kind of thing that makes me kind of a little bit crazy and jumping around every time I see this. Why? Because you have a lot of people that say, okay, if you stick to the S&P, then you always make it back. Yes, but the clear assumption here is that, let's assume that, so the chart starts probably in 1950. We are in 2025. So the only way to achieve that kind of return, so basically this means that you would have to invest into this before you are born, probably if you are not retired already and you are investing in markets. So this means you would have to invest before you are born and hold to it until today. This is what that means. This is totally unrealistic. Yes, we had some drawdown, it recovered, but no one can live with this. This means that you have no life, you have no investment, and the day you can use the proceeds of the results of your investment, you actually mostly dead. So basically, what's the point? And if you look, you have lost decades in that kind of graph. This is something that I'll probably show you next time. But if you look at this chart, and let's assume that you have some investment at the top of the 2000 peak, and then you go through 2000, 2004, and then 2000, 2007, the market only recovered and significantly went up after that. I believe it was in 2013. So that's 13 years where basically you could not have touched your portfolio. So in the meantime, if you needed money for anything, basically to live, let's say a health issue where you need money, you need to pay for your kids' education or whatever, you could not. So so I understand why these guys are sharing that kind of chart, because that's basically their bread and butter. It's okay, invest, we collect the fees, you experience the drawdown, and you have to stomach it until you make money. I'm sorry, that's totally unrealistic in the real world, and this is why I believe you need to be active. And this doesn't mean not being long equity markets. You can still hold this long equity market, but you need something that diversifies these equity markets on the other side to help you manage the drawdowns and mitigate the risk. So I'm done with my rant today. Let me check if I have a couple of questions. Probably not. Everyone is sleeping right now. Okay, that's fine. Thank you for being here. I'm done right now. I was hoping for a little more questions. To be honest, but that's the way it is. I'm also concerned that probably some people left LinkedIn. It seems that there was a disconnection on LinkedIn, and when there's disconnection on LinkedIn, LinkedIn very often fails to reconnect, which is not true with YouTube. YouTube is a much more stable platform for streaming. Anyways, thank you very much for being here. I think we are living interesting times on the market. I love that because that helps me, decode the market, find new stuff, stress test the strategy, and then come out better out of it. So I hope you do as well. You can manage the risk. One of the main objectives in the market is to stay alive in the market. It's only over when you're dead. It's true in life, and it's true in the market as well. So as long as you're not your
let's say your brokerage account doesn't hit zero, you're still in the game, and this is what you desperately need to try to avoid getting bankrupt. So avoid higher leverage, diversify your portfolio. It's always the same basic advices, but that usually works. Thank you very much for your time, and hopefully see you next week and on Monday with the Croissant Files. This, if you missed some of the dashboard, this will be available as a video on YouTube. I'll try to post it pretty rapidly if my wife gives me a little bit more time, free time to do that this afternoon. So thank you very much again, and see you next week. Bye-bye.